There is so much uncertainty right now, and the stock market, we know it, it hates uncertainty. The stock market has corrected, it has been volatile. There is a lot of uncertainty in the news right now. Thankfully, my dividend stock portfolio has weathered the storm really well. In fact, on some of the worst days recently in the stock market, some of my largest positions, like PepsiCo, which owns this bubbly, sparkling water over here, surged in value. I have stocks like Johnson & Johnson, PepsiCo, Altria, British American, ticker BTI. These surged in value, and they weathered the storm really well. In fact, I have a stock where I'm yielding 10% on cost on a tranche that I bought pretty recently, just over a year ago. I'm going to share that in the video today. It weathered the storm. What is going on here? What can we learn from this? During times of turbulence, I have a few takeaways. As you can see on the screen in front of you right now, when investors get spooked, there is a flight to quality. There is a flight to value. Value, the types of dividend stocks I buy, like PepsiCo, J&J, these are considered value stocks. They're also, of course, considered quality stocks. Also, though, consumers and investors alike will go towards these everyday essentials and these comforts in life. Essentials like healthcare, everyday essentials like sparkling water, food, CPG products, and of course those stress relievers like SIN stocks. Dividend stocks, I love them all the time, but I love them even more during markets like this. There's two things that dividend stocks can really help in a well-diversified portfolio. As you can see on the screen, first and foremost, these stocks pay tangible cash dividends. One of them that I'm going to share is paying me 10% yield on cost on a recent tranche. And those tangible cash payments, they can buffer downside. They can cushion the downside in a stock portfolio. Also, dividend stocks alone, because they are value-oriented, can cushion a portfolio because the types of stocks I own, they tend to have less drawdown during a market crash or a market correction. And we saw through recent events that some of these stocks, they even appreciate in value during big red days in the stock market. And so I am so proud to be a dividend investor and to have proper diversification for markets like this because of my risk tolerance. I invest for the cash flow from the dividends, but I have a backup plan. The equity value of my dividend portfolio matters. I don't want to see it sink overnight because in the event that I do need to sell stocks in the future, I want that equity value to be there just in case. So I don't like a lot of drawdown, and I've diversified accordingly. But I want to talk about a case study today. As you can see on the screen in front of you right now, owning dividend stocks, in my opinion, it's not enough. For me, at least, I not only need to buy high-quality, value-oriented dividend stocks that provide these essentials and these comforts, but I need to buy it at the right price. I need a margin of safety, if you will. So I want to talk about Altria a little bit here in this video. I think Altria this week has surged in value, and this is a perfect case study in diversification and buying with a margin of safety. And so I'm an investor. I don't like too much portfolio-wide volatility, and Altria going very heavy in that stock. You might remember it was about a year and a quarter ago. I'm going to link to the video in the pinned comment below. I went heavy. It has served me so well. I'm not buying it here, and I'm taking money off the table, but let me just share that with you. Check it out on the screen right now. So what you see in front of you is an analysis. I'm showing on the left where I bought my huge tranche of Altria that increased my portfolio income 11.8% overnight. And on the right, you're going to see where Altria stands today. So, in terms of capital appreciation, in just about a year and a quarter, I'm up 40.8% in terms of capital appreciation. Obviously, I bought it when it was on sale because I wanted a margin of safety. Now that it's appreciated over 40%, I certainly have a great margin of safety. You can see when I was buying it back in 23, it was trading at a forward PE in the 8s. Now, in 2025, it's trading in a forward PE in the 10s. But let me share in the third column, I highlight some of these metrics in yellow. This is more of a side topic, but you can see the EPS, earnings per share, has grown. It's the growth there has been about 19%. And so we think about a company like Altria. I get comments all the time, Ian, it's going out of business. Ian, you shouldn't have invested so much in it. Ian, you're taking on risk. This is not a growth-oriented company. Well, the numbers that I look at show something completely different. I'm seeing EPS growth over there at Altria, which supports a growing dividend over time. But as you can see on the screen in front of you right now, let's keep going. So next I want to talk about dividends. When I bought the thing, it was yielding 9.75%, but they've increased the dividends since then. So my yield on cost right now is 10.2% simple. And I should look at simple because I'm not reinvesting dividends. But the starting yield now, because the stock is appreciated, it's only 7.21%. I'm not buying here, especially as the thing has surged this last week. But surely I love having this in my portfolio for diversification during these types of rocky markets. They're growing the dividend by about 4% per year on average over the last 5 years. But here's actually one thing I want to share. And again, this is a tangent. It is a related topic, but I want to talk about my de-risking strategy. So I've already de-risked this position. I've been in it for about 1.25 years. So because I'm yielding roughly 10%, I have taken those dividends as cash and I have selectively reinvested them elsewhere and or spent some of them. So I've taken about 12.5% of my capital back from the company, not accounting for taxes, as just dividends. And so I have about 87.5% of my capital remaining on the table. So I have a position with 87.5% of the capital left in it, and I'm up about 40% or so on it. And in perpetuity going forward, I'm yielding about 10%. This was the thesis all along when I bought the thing. I want to de-risk it by taking the capital out of it over time. And I want to hold it because I believe I was buying at a large margin of safety and getting a lot of dividend yield. And what this last week has shown me is, boy, there is a flight to quality, a flight to those everyday essentials that consumers love and investors love during times of unpredictability. And so this is part of my dividend diversification strategy. But I want to keep going. What was I buying this week? What did I do? Was I buying Altria? No. I love a good stock market sale. I'm happy that stocks were correcting, and I get even more happy. Not only were stocks correcting, but the ones I want to buy right now are correcting. Was PepsiCo correcting? J&J, Altria, stocks I've already built to size correcting? No. Those ones buffered the portfolio really well. But Alphabet, as you can see on the screen, I might do a whole video on this at some point, but my patrons already know this. I'm going to link to my Patreon in the pinned comment below. On Patreon, I share my trades on both tiers, Backyard Patreon and Corner Patreon. And I've been buying Alphabet. It's been a passion of mine to add to this position this year because I believe Alphabet right now is trading with a margin of safety. I see some deep value there. I don't want to go into all the metrics today, but it's trading at a forward PE on 2026 earnings of about 17, 18 range. And when the market corrected, I was buying this. Not only is the market correcting, but my portfolio is weathering the storm well. I have cash flow coming in like crazy from my 10% yielders like Altria, and I'm redeploying it. And I'm using that capital to buy stocks that are of very high quality, that are on deep discount. And I believe Alphabet is one of those. And so that was what I was doing this past week. But I want to keep going because a lot of us, and I'm going to say even myself, I feel good here. I feel good. I'm sharing some of my wins here on YouTube. It's not always this way. Of course, I've been through it all. I've been investing for many decades now. I've seen it all. I've been through it all. I've learned lessons the hard way. And so I'm sharing some wins, but please at home, if your portfolio went down or you faced some challenges, look, I've been through it all too. And I want to actually close on that because that's one of the reasons, as I'm in my mid-40s now, I get older, I felt good this week looking at the portfolio, but let's say it didn't look so good. Let's say, and it's very possible in the next correction it won't look so good. Maybe Altria will get clobbered. We don't know. But as you can see on the screen, one of the things I want to surface just as part of my diversification strategy is SCHD and ETFs overall. SCHD is my top goal for this year. I'm adding to that ETF. And one of the reasons for that is on any given day, SCHD is comprised of 100 or so stocks. Some are going up, some are going down, but I don't see it. I don't see it. It's an abstraction. It allows me to work, to navigate life, to look at things at a higher level. And I don't have to kind of peer down into that ETF to see how the individual positions are doing. I'm sure during the correction, some of the positions were way down, but I didn't see it. I just saw the overall SCHD and it did pretty well. It was very non-volatile as compared to the market, if you will. And so the closing thought for the audience out there, all of you, thank you so much for watching, by the way. Please click the like button if you do enjoy this video. But this is not only for you, it's to remind me, hey, Ian, focus on SCHD because you kind of got lucky this time. This was a good week for you, but it may not always be that way. And so you need to kind of diversify. And just by diversifying alone into high quality value oriented companies, which SCHD does, it will buffer my downside. But also having ETFs, I just don't have to look at it day to day. I let the ETF do its thing. I live my life. Everything is great. Because I'll give you an example. There's another stock in my portfolio, Chevron. Chevron did really poorly this last week. And I'm okay with it. I got lucky again because Chevron, it's not a huge position. It's a position, though, I want to add to. I want to build Chevron. So I kind of got lucky like I did with Alphabet, and it went down a lot, and that's good. It's setting it up for me to buy more. But it may not always be that way. It may be Altria next time. So we'll see. I'm just staying diversified, and I'm trying to buy value when it's on value because I'll get a margin of safety. I try to have the big dividends coming through because they buffer my downside, and I just try to stay the course, stay in it for the long term because I know that volatile markets throughout history, we've gotten through them. So I look for the positives in all of it. Anyway, I appreciate you watching the video today. Please go ahead and subscribe if you have not already. I have more videos on the way all the time. Before I go, in terms of a full disclosure, I own the stocks and the ETF mentioned today. I am long PepsiCo, ticker PEP, Johnson & Johnson, ticker J&J. I'm long Altria, ticker MO, British American, ticker BTI. I'm long Chevron, ticker CVX. I'm long Alphabet, ticker GOOGL. Also, I'm long the ETF SCHD. And before I go, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market, and please consult your licensed financial advisor before making any money related decisions. Also, today's video, it's not tax advice. I'm not offering any kind of tax advice. Please consult your licensed tax advisor before making any money decisions. Thank you for watching. As always, I'll see you in the comments section below, and I'll see you in the next dividend stock investing video.